You ever look at the headlines, the ones screaming that the economy is booming, but then you look at your own situation and think, wait, really? For who exactly? If you've ever felt that disconnect, you're not alone. Today we're going to dig into why those official numbers can tell a story that just doesn't feel true for so many of us. Let's get into it.
This quote just nails it, doesn't it? It perfectly captures the whole problem. Economic averages, like GDP, are designed to smooth everything out. But in doing so, they can hide a really painful reality. They blend the scorching hot with the freezing cold and give you a comfortable middle that doesn't actually exist for anyone. That's the illusion we need to break through.
So if the average is a lie, what's the truth? Well, to see what's really going on, we need a new way of looking at things. We need to understand the anatomy of what a lot of experts are now calling the K-shaped economy. And the name really says it all. Just picture the letter K in your mind. After a big economic shock, like a pandemic or a recession, we all hope for a V-shaped recovery, where everyone bounces back together. But that's not what's happening. Instead, the economy splits. One part shoots upward and to the right, while the other part trends down. Two completely different paths moving in opposite directions. And this right here breaks down those two realities perfectly. On one side, you've got the upward arm. This is the formal digital world. It's wealth that comes from owning assets, stocks, real estate. It's the world of high-income earners in booming industries like tech and AI. But then, there's the downward arm. That's the informal physical world, where your income comes from your labor. We're talking about lower-income folks, small businesses, and sectors that are lagging behind. Two different worlds.
Okay, these abstract concepts are great, but to really truly understand the human side of this K-shape, we need to move past the charts for a second. We need to hear a story. A tale of two fortunes.
So first, let's meet Rajesh. He is the personification of that top arm of the K. He's a senior manager in a big city, and here's the key thing. His financial life isn't just about his paycheck. It's all about his investment portfolio.
And get this, during all the recent economic chaos, Rajesh didn't just scrape by. He absolutely thrived. As the stock market was hitting one record high after another, his personal wealth grew by 20%. His money was literally making more money for him, widening that gap even while he was asleep.
Now let's flip the coin and meet Suresh. He lives in a smaller city, runs a small business. He represents the other side of the story, that downward arm of the K. For him, every single rupee he earns is directly tied to his physical labor and the day-to-day economic health of his local community.
And wow, this chart just says everything, doesn't it? You can actually see the K-shape in what people are buying. In Rajesh's world, sales of luxury SUVs are off the charts, hitting all-time highs. But in Suresh's world, sales of basic scooters, the workhorse vehicle for so many, are still struggling to even get back to the levels they were at in 2018. It's just two completely separate economies playing out in real time.
But here's where the story takes a bit of a turn. This divergence, this inequality, it's starting to evolve into something that could be a lot more dangerous. The K-shape is transforming into a new, far more unstable structure.
People are starting to call it the barbell economy, and the image is perfect. Picture a barbell. You've got these heavyweights at both ends, extreme wealth on one side, extreme precarity on the other, and they're connected by this thin, fragile, snapping middle. The problem here isn't just that it's unequal, it's that it's unstable. It's a top-heavy system that frays the social fabric and makes the whole thing incredibly fragile.
So just how fragile are we talking? Well, look at this. A whopping 40% of the entire value of the S&P 500 is now concentrated in just the top 10 companies. That is a historic level of concentration. It means our entire economic stability is dangerously dependent on how a tiny handful of mega companies are doing. If they trip, we all fall. That is a massive concentration of risk.
Right, and this is the crucial mechanism to understand. Our economic growth right now isn't really being fueled by most people getting raises. It's being driven by something called the wealth effect. Basically, the top earners are spending money not because their wages went up, but because their stock portfolios look good on paper. Their consumption is completely tethered to the mood of the market.
And we're already seeing the first major cracks appear in this system. That aspirational consumer, the professional who's trying to climb that ladder into Rajesh's world, they've pulled back hard. Luxury spending from that group dropped by a staggering 35%. The bridge connecting the middle to the top is already showing signs of buckling.
So this all leads to a critical question. Where does this fragile barbell economy go from here? As we look down the road, analysts are really seeing two very different, very distinct paths forward.
Okay, so on one hand, you have scenario A, where the K-shape just gets deeper. The stock market, maybe fueled by all this AI hype, keeps the top-end spending, while weakness in the rest of the labor market just doesn't even make a dent in the overall numbers. The alternative is scenario B, a broader recovery. In this world, things like stimulus or lower interest rates could actually strengthen the entire labor market, with growth spreading beyond just a handful of tech giants. The big risk there? That kind of widespread spending could bring inflation roaring back. It really is a 50-50 toss-up.
All right, we've talked about Rajesh and Suresh. We've talked about these big economic trends. But let's bring it all home. What does any of this actually mean for you, for your career, and for your money? Well, if you're a young professional, and maybe you're not a huge investor yet, this isn't some abstract economic debate. The K-shaped economy shows up as a very real, very frustrating problem, what feels like a broken ladder for getting ahead.
Here's how it plays out. First, there's the lifestyle squeeze. The wealthy folks at the top of the K have so much capital that they bid up the price of everything, essentials like housing and education, making you feel poorer even if you get a raise. Second, there's the job trap. AI is great at creating a few very high-paying jobs, but it's also eliminating thousands of the entry-level roles that used to be the first rung on the ladder. And what you're left with is the great divide, where the jump from Suresh's world to Rashesh's world starts to feel less like a climb and more like an impossible leap. Now, for those of you who are investors, navigating this kind of tricky environment requires a really clear game plan. The core advice seems to be, stay in the market, but don't just set it and forget it. This means actively managing and diversifying your portfolio way beyond just a few hot tech stocks. The strategy shifts from making speculative bets to focusing on high-quality, stable companies and adding real assets like bonds or even gold that can act as a shield against all this instability.
So, at the end of the day, this is the reality we're left with. An economy of averages that's hiding a great divergence. For a society to be truly healthy, the ultimate goal has to be to bend that downward arm of the K back up, to turn the whole thing back into a V shape, where recovery and prosperity are shared by everybody. Which leaves us with the single most important question of all. How do we do that?